there, everybody. Hope you've all had a good day and you're excited to find out a bit more about mortgage strategies and how we can get you mortgage free faster and basically, yeah, take control of your financial future. So, right, I'm Karen. Today I'm going to be presenting some information about your mortgages and how we can get mortgage free faster. So, here we go. So first of all, our agenda for tonight is we're going to look at the realities of mortgages in New Zealand. It does change from time to time, but it's a really interesting time for us to be looking at it. We're going to be talking about our mindsets and what things can hold us back. We'll be looking at our strategies to help accelerate your mortgage, particularly in the market that we're in at the moment with interest rates, and how do we build wealth through leverages. And at the very end, we will be looking at some question and answers. So hopefully I can speed through and not do my usual thing where I talk too much. It's just me. And then we have questions and answers that you guys want for me to cover. Just a little bit about me. So my name's Karen Beckham, not related to David as far as we know, but I'm a financial advisor or a financial personal trainer, as we call ourselves here at Enable Me. I've been in banking for over 30 years. So that was in my previous life. I was a branch manager for over 20 years. I worked in a premium banking centre, which was looking after high income earning clients. And I think my specialities is using all of that knowledge that I've had for over nearly 40 years in banking to help people get ahead in life now. So I'm a coach here at Enable Me, and it's a job I absolutely love. So here we go. So the disclaimer for this evening is obviously the presentation is provided for information purposes only. The content of the presentation is not intended to be a substitute for regulated financial advice. If you'd like financial advice, you're very, very welcome to come and have a chat to us at Enable Me. So we're going to start off with a bit of a poll question. So just for everybody out there this evening, we want to know, are you mortgage free? So the answers we have the choice of is yes. Well done if you are. The second one is I don't own my own home. So that's interesting. The second one is no, I'm not mortgage free, but I've got more than 15 years to pay off my mortgage. Or no, I'm not mortgage free, but I've got less than 15 years to pay off my mortgage. And the last option, I am mortgage free. Well done. But I don't have any investment properties at the moment. So that's our poll for starting off. So if you'd like to do your vote, that would be wonderful. We should be getting our results in now. Right, we have them here. So 59% of the people on the call that responded tonight say that they're not mortgage free and they've got more than 15 years to pay off their mortgage. Right, okay. And then we have 27% of the people on the call that have answered that one, and they aren't mortgage free and they've got less than 15 years to pay off their mortgage. So that's just an interesting mix of people. So we really want to get you mortgage free as quickly as possible. So that's our goal to help you. So here we go. What can we do? So first of all, talking about being mortgage free, why do we want to be mortgage free? And it's really about financial security. The financial security of having no mortgage means that we've got peace of mind and we've got lots of options. We've got the ability to stop or change our work. So we might decide that as we're mortgage free, we don't need to work the hours that we've worked, or we want to do a different type of work. So that gives us that sort of freedom to do something a little bit different there. We've got our abilities to follow our passions. So that could be traveling or spending time with family. There's all sorts of things that people want to do when they have that financial freedom. It also helps provide stability during volatile times. And obviously a mortgage is a big commitment that we have. So getting rid of that as quickly as possible helps. And obviously then giving you independence, because it means that you can do the things that you want to do. You're not obliged to have to worry about paying a bank huge amounts of interest. Right. So what represents financial success? Now, this is different to everybody. Like everyone I know defines success differently. So whether it's family or whatever it is, but some of the things that can define financial success is being in control and having a plan. That is a really, really important thing. Feeling like you have control. Being mortgage free, investing and creating some wealth, being set for retirement. That's very important, particularly important to me because I'm in my slightly later 50s now and retirement's not too far away for me. So this is something that's really high in my mind, and having financially independent children. So some of the realities of mortgages in New Zealand is very interesting, but 46% of income is being paid off mortgages. That's a huge amount of our incomes. When we think of everything else we could be spending our money on, 46% of that is going into paying off mortgages. 59% of people are feeling quite stressed about their mortgages, and that's not a good news story. The average first home mortgage is $550,000, and that's up from $300,000 10 years ago. And that is actually a really scary thought. 57% of new home loans are now issued with a loan term of 30 years. Now, when I first worked in the bank, it was 20 years. Then they pushed it up to 25 years, and now it's 30. So the next fact is that the average first home buyer now in New Zealand has risen to the age of 36. So if you're 36 and you're taking on a 30-year loan term, you will be 66 before you are mortgage free if you follow the standard way that you pay off your mortgage over time. So we do not want that because we want to give you some time to be mortgage free and growing wealth for retirement. So there are things that we can control and there are things that we have no control over. And I think you just need to watch the news tonight and you'll see half of this was on the news. So the things that we have no control over are things like the OCR and interest rates. And at the moment, we're all excited because the OCR's dropped, interest rates are dropping. So that's great news. We can't help much about the geopolitical tensions around the world, and there's a lot of those at the moment. Market crashes, they happen from time to time. We have no control. The government settings, they will change things. The government changes from time to time, and different governments will change different things that impact on us. Unemployment rates, a bit high at the moment, seems to be coming down a little bit, but that does not help anybody. And recessions, that's part of the economic cycle. They will happen from time to time. We need to be resilient to get our way through them. And of course, Donald Trump's favorite, tariffs. So we need to make sure that we can cut through all of the those news stories and really just focus on what you've got control over. So what we've got control over are things like really just cutting out that noise. You can't let it control your life. You need to control your life. So we need you to look at defining your starting points where you are today and decide what the problem is you're wanting to solve, which is getting mortgage free quickly or getting enough equity that you can start to do other things in life. And from there, what is that time frame that you've got? Every year you get closer to retirement, hopefully. So it's really important to just think about that time. That time gets shorter and shorter the older we get. We need to be able to harness our behavioural tendencies, and that's something that I'm quite passionate about because I will tell you my story about what my money personality is in a minute. And then we need to look at our ability to leverage our equity to be able to grow wealth in the future. So understanding our tendencies, when we're looking at our money personality, it does change from time to time. And when you've got a financial coach that actually helps you with regards to thinking about how you spend your money and being conscious, your money personality can change. So we have three money personalities. We have our shoppers, we have our plotters, and we have our savers. So if you're wondering what the plotter is, sometimes I think the term doesn't sound too good, but it's actually a really good money personality to have. A plotter can save when they want to, but they can spend when they want to. So they don't get anxious as our savers do when it comes to spending money. Or our shoppers that are happy just to spend and really have no goals, and they just go for life enjoying themselves, which is great, but at some stage they're going to come a bit unstuck. So I can personally attest to the fact that you can change if you are a shopper. I was a shopper quite a few years ago, and I've really changed the way I think about money and where I want to spend my money. And so I would classify myself more as a plotter now, which I think is really good. So if you're out there, think about what your money personality is. It's just really interesting to think about it. The other part we have a look at is we look at your cash position. So this is how you feel personally about your financial situation at the moment. We don't want to be in the boat that's got the hole in it, which is the sinking one. But sometimes we feel that way, when things don't go quite right and we have, different issues that come up and we just can't afford to pay for them at the time. So that sinking feeling, not a good position to be in, but some people feel that they are there, and that's one we need to help you get out of. Then we have our people that are floating. So floating means that you can do the things that you like to do, you can afford the bills, but you may not feel that you're getting ahead at a great rate of pace. And often we hear people say that when they're floating, they feel like they live paycheck to paycheck. They don't really have a lot left over, but they're doing okay. And then we have the last cash position, which is actually flying. And flying is where you've got enough money to do the things that you want to do. You can pay your bills, you can go on the holidays, you don't have to really think about it. But often when we're flying, we actually stop having a plan because we just don't have to worry about it. But the thing is, when we stop earning and we go into retirement, we aren't flying necessarily anymore, unless we've been really, really wise with our investments and our money. And then we have our approach to risk. And this is really important because this actually helps us get ahead or not get ahead or be too afraid to do anything. So we've got three different approaches to risks. We have our safety wardens, and our safety wardens are the people, they're sort of like the people that do all of the compliancy kind of things. They're always looking for what could go wrong. If something was going to go wrong, they work it out what it could be. And that often will stop them doing anything. So then we have our adventurers, and they're the ones that just jump in and go, "Yep, that sounds like a great idea. Off we go. We'll just do that." Great attitude to have. And then the next one we have is our dreamers. Our dreamers really would like to do it, but they actually just procrastinate a little bit and don't quite get there. So those are the different approaches to risk that we have, and that's just about us as people, who we are and how we feel about things. So you can focus on three things to help yourself during any economic environment. So the first thing is you need to be able to maximize your savings. Then you need to look at crushing your mortgage, getting rid of that as quickly as possible, because by doing those two things, they help you unlock your equity so you can build wealth. So if you're thinking about it this way, you're paying off your mortgage as quickly as you can, so that's reducing your debt. So you're getting rid of that, and hopefully house prices start to go back up. That increases your equity, and then you're off to be able to build some wealth. So how do we actually look at maximizing our savings? So how do we increase what's left over? And this is where we are so good at Money Fit and Enable Me at being able to do this for you. First of all, you need to have a plan to work towards. It's like if you go to the supermarket and think, I'll just spend whatever, doesn't matter. When I get to the at the end and my trolleys fill up, I'll just put it through and I'll just pay for whatever it is. You need to have a plan. You need to have some ideas about how much you want to spend. So if that's a priority for you, that's important. Have a good idea of what that budget's going to be. So we need to benchmark and we need to track your spending so we understand where your money is going to. That's really important, and that can actually really help you understand if you're frittering money, where is your money actually going? Because often people have a budget, they'll sit down and write out what comes in, what they think goes out, and what should be left over, but not tracking it means that you don't always know where your money's going to. We need to help you establish really good systems of how to manage your money. And that's not having 101 bank accounts, one for the rates, one for the insurance, one for the car, one for the holiday, one for Christmas, all the rest of it. It's all about having simplified bank accounts so you know what's what and where money goes, and that you've got the money put aside for what you need it to do. You need to work out what are your non-negotiables. So your non-negotiables are the things that give you joy in life. Now, I know when we had triple CFA came out and the banks were all under these really these big restrictions about how they could lend you money, it was always the coffee or the avocado and toast. But your non-negotiables are the things that you enjoy doing. So you don't want to give up things like, it's avocado and toast. For me, it would be coffee. You don't want to give those things up. So you need to know what gives you joy in life that you still want to spend your money on, because you don't want to get rid of that, because that would be just like going on the most terrible diet. So we don't want to do that. But we do want to eliminate fritter. So we do want to stop the money disappearing we spend it on things that we can't even remember what it is. And that's how we really maximize our incomes. So when we're earning more, it doesn't necessarily translate to having more progress, because what often happens, and this is the thing that we've got to be really careful of at the moment with interest rates coming down. So if you're on a higher rate and you're going to end up, going into a lower rate, that gives you a little bit more money in your pocket. But what we want to be really careful of is not allowing you to spend it all, because once you do that, that's that lifestyle creep. It means that you're starting to spend a little bit more than you were before. It gives you a bit of joy, but then you could feel like you're wasting it. So you've got to be really careful about what you actually do with your next step. If you're coming off a fixed rate, let's really get a good plan about how to get you mortgage free quickly, because that's a long-term plan. So this is our happiness graph. I love this one. So apparently we fritter about 15% of our income. So it's really important to work out what those non-negotiables are. Eliminate the fritter. The fritter's that stuff that you can't even remember what you spent your money on, and just remove all the inefficiencies in the way that you manage your bank account. And that obviously then gives you that more money sitting in your wallet. So minimising your fritters. So we estimate there's about 15% of Kiwis, or Kiwis fritter about 15% of their income on things like discretionary spending. Now, I always talk about number one, the discretionary spending, which is your takeaways and your trips to the supermarket. I always say to my clients, with your trips to the supermarket, try to do one big shop online if you can, even if it's a click and collect, but always keep a little bit of your budget aside for one extra top-up shop during the week. And that's the one where you've got to go in and get milk and bread and eggs and those type of things, but just have a smaller amount of your budget put aside so that you actually are controlling it. If you go into the supermarket every day, you will be frittering a lot of money on food that you really don't need. And takeaways, we're all busy, we all have busy lives, so trying to make sure that you've got some nice easy meals that you can cook. Have and take away every once in a while, but try not to be so exhausted that you come home and you just can't be bothered cooking. You've got good food in the fridge and the pantry, but you get your takeaways instead. So that can cost. The subscriptions is another one. So subscriptions, even I've got one. I talked last time I had a webinar. I've got a subscription. I did over a year ago to Acorn TV. I don't even know why I did it. I've never watched it. The other day I got charged I think it was $147 for renewal. I don't even know how to get rid of it. So it happens to us all, but just watch those subscriptions, because when we get Disney, Neon, Netflix, Apple, Prime, Sky, they all really add up, and just be careful that you know what you've got, and if you're not watching them, get rid of them. Structure is really important. So mortgage structure is really, really vital. I used to see a lot of people that would have one loan, so one mortgage. So say, for example, it was a mortgage of $350,000. It was good when the interest rates were low, but when those interest rates went on to the higher rates, they got what they call interest rate shock. So they might have gone from a 3 or a 4% mortgage and they went on to a 6 or 7. So it's really important to structure your mortgage in such a way that you've got some flexibility in there, but also you're not going to get that shock. Utilities, always shop around. I see some people that have they spend a lot of money on their phones, particularly if they've got kids. So make sure you're shopping around for your utilities. Bank fees, you shouldn't be paying them. So if you're paying bank fees, you don't have your accounts under control or set up the right way. So when we're talking about crushing your mortgage, it's not actually about the interest rate, although interest rates are important in the market we're in at the moment, but it is about the pace at which we do things. So it's really about focusing on reducing your fritter, keeping as much money as you can available, and then being able to have a strategy to pay your mortgage off quickly. So why mortgage acceleration? Because we want to get mortgage free before we hit retirement. I see a lot of people that are in their 60s and they're going to have a mortgage, and it is scary, really scary. So we want to get your mortgage free as quickly as we can. Being mortgage free, paying off faster means that you're paying less interest to the bank, then you're freeing up your ability to invest elsewhere. And as I said before, if we're looking at the fact that we're paying off our mortgage, that's getting smaller, hopefully our house prices do creep up a little bit, that gives us more equity, and that equity gives us the ability to leverage and grow our wealth. This is just an idea of what happens if you've got a home, a first home. We talked about the first home having an average mortgage of 550,000. So if that interest rate was 4.99, if you're paying that mortgage off over 30 years, the interest you'd pay to your bank would be about $510,000. If you can accelerate it and pay it off over 15 years, and I know a lot of people are saying that they've got more than 15 years to go, if you're at that around that 15-year time frame, you'd be paying about 231,000. If you can accelerate even faster and pay it off over 10 years, it's about 148,000. So potentially you could save yourself, if you can get mortgage free after within 10 years, about 453,000. That's huge. And that's the profits the banks are making from that, obviously, part of that. So if your mortgage is larger, and so for a lot of people, we'd say, oh, that'd be so nice to have a mortgage of 550,000. There are a lot of people out there that have much larger mortgages on their own homes. So if your mortgage is about 850,000, so you might be living somewhere in Auckland, and paying again that same 4.99%. If your mortgage is over 30 years, so if you're 36 years old, taking out your first mortgage, and it's about 850,000, you'll be paying back to your bank about 700 or just round up $790,000 over that 30 years. If we can get you mortgage free within 15 years, that goes down to 356,000. If we can get you mortgage free within 10 years, it's 228,000. So the potential savings there is about 561,000. Massive difference to your life. So we have a few different types of terms that we talk about when we're looking at mortgages. The first one is refixing. So refixing means that you've come off your fixed rate and you're now looking to think, what do I do? So you just refix it. So you might say, well, it's on a 12-month fixed rate. The new 12-month fixed rate with my bank is now 4.57%, and I will refix it. So that's refixing. Refinancing is when you think, I might look and see if there's another bank that might give me a better deal. So if you've received a cash contribution that you might have to pay back, so you have to think about this if you're looking at refinancing, you might get a better deal elsewhere, and that could be a cashback from the new bank. It could be better terms. Refinancing, that's that term there. Restructuring is when we optimize the way that your mortgage is actually set up, and that gives you flexibility to pay it back faster. And that's what I said, rather than having one mortgage with one amount, structuring it so that you've got one or two or three mortgages over different timeframes can be a really good way of helping you get flexibility, getting rid of that interest rate shock, and just having the flexibility to pay something off a little bit faster, and rates coming off at different times. I have heard so many people in the years I've been banking saying, I want to be mortgage free. And then we say to them, well, what happens when you're mortgage free? What are you going to do then? Don't know, I haven't thought about it. I just want to be mortgage free. So it's really important to understand what being mortgage free means for you, because it can unlock a lot of different opportunities for you. So first of all, we want to unlock our equity so we can build wealth. That's a really important thing to do, particularly if you're heading towards retirement, like myself, 8 years to go. So we want to make sure that we unlock our equity in our property, which is our homes or our investment properties, to build wealth. Do you know how much you need for retirement? Most people don't. We read all the surveys. You need $1 million, you need 500,000, but actually you need what you need. So everybody's number is different. At Enable Me, we help you work out what your number is, and that is all based on what you spend your money on. Some people are quite frugal and their number could be lower. Other people's lifestyle might be a little bit bigger and their number's bigger. So it is different for everyone. But it's really important that we know what it is so we can actually make sure there's no retirement gap. So this graph just shows you the difference between the effects of actually getting mortgage free faster. So if you could get mortgage free, so you're taking out your first home loan and you could be mortgage free by the time you're 55, that gives you a lot of extra time to save until you turn 65. It gives you a lot more money in retirement. Whereas if you're the person that's 36 today and is taking out a 30-year mortgage and you turn 65, and you've got very, very short amount of time to save. So that might be your Kiwi saver that's been working away, and then it just disappears really quickly because you just haven't had the chance to create wealth any other way. And as I said, there's a lot of people, 59% of Kiwi mortgage holders are experiencing mortgage stress. So we really need to help you control what you can control. So if you could actually pay off your mortgage earlier and you can grow your wealth, and we can do this in other ways. If we know that your wealth gap is about $500,000, then we know that we need to look at a strategy to get you to grow wealth. And this is what gives you the opportunities to get mortgage free faster. So you can see from the age of 55 to 90, it's a really long time that we're in retirement, and we've got to make that money last. So it's a long time there. So 38% of people between the ages of 55 and 64 are mortgage free. Fantastic. But there's a lot of people, obviously, that aren't. So if your retirement gap is bigger than $300,000, you're very likely going to need to use some leverage to actually bridge that $300,000 gap. So I'm going to explain what leverage is and how the power of leverage works. So I want you to think about the fact that you've got equity in your property, and you can now use the equity. So for example, you've paid down your mortgage and the house is worth, say, $1 million and your mortgage is $300,000. You've got $700,000 worth of equity that you could then leverage to buy an investment property. The investment property that you could buy could be worth $800,000. So suddenly you've got this asset that's worth $800,000 that appreciates in value. So if we're using the 6% growth rate, that return would be about $45,000. If you look at it the other way and you think, right, I'm going to try to save my way out of my my retirement gap, and you start putting money aside, so you've got $160,000 to invest, you put it in at a managed fund earning 6% in a growth fund, your return is $9,600. So $9,600 compared to 45, and all you're doing is leveraging. You're using your property to grow your wealth. We have used the example here that you are topping up the investment property by $60 a week, but that's your investment. And that would be the same as if you're investing in a managed fund, because you want that to grow as well. So that is your investment. And that's the way that leverage works. It's very, very powerful because you're using the bank's money to grow your wealth. So when we talk about capital gains on property, there's a few things that we look at. So one is the interest rate cycle. So at the moment, we're all quite excited because the interest rate cycle it's going down. So we just had the OCR announcement. They dropped by 0.5 basis points last week. We've got another OCR announcement on the 26th of November. We're thinking it might go down again. That's what everyone's predicting. They're all getting out the crystal ball. So they're thinking it might go down again. So that kind of helps property capital gain, because if the interest rates go down, people can afford to borrow more. So that pushes the house prices up generally. The other thing is location. So if we're wanting to get a property that's going to have some good capital growth, we need to look at growth regions. So there's regions within New Zealand that are doing extremely well at the moment, and those are the kind of areas that you'd be wanting to invest in. So you're going to look at things like where the council infrastructure is going into, are there subdivisions, are there lots of developments, are there new schools going in, what's the property supply like in the area. What's the type of properties that are available? So are they new or they're old? If somebody's wanting to rent a property, they do normally like to have a nice new home to live in, not an older property that, may be a bit cooler or whatever, although we do have home standards. but also the net migration, that's really important. So how many people are coming into the area. The timing of the property cycle is also a thing that will drive capital gain. And then the last thing is government policy, and that can have a massive impact on what happens in the economy and properties in New Zealand. So we have other options for growing wealth other than investment properties. We have things like cash. Now you can see that there is a low risk, low return. As we move up the graph, we've got term deposits and bonds, slightly higher return, a little bit more risk, but not really. Then you've got your managed funds. Managed funds, we always say it's like taking the roller coaster ride. You hold on and hope that Donald Trump doesn't say too much to make your KiwiSavers and managed funds bounce around too much. Then we've got property, shares, and then we've got business. And whatever the right option for you is different for everybody, and it really depends on what you're trying to solve. It depends on your time frame, and it also has a regard on what your risk appetite is. So you've got to have a good plan. That is a must. You've got to understand what the problem is that has to be solved. You need to understand your financial tendencies. You've got to remove the financial inefficiencies. You've got to create some good systems, setting up your bank accounts. You've got to develop a wealth mindset. That's really, really important. Focus on execution, because it's nice to have a plan, but if you don't execute on it, it's just a piece of paper. And then you need to be able to adjust and reset as you're going. One of my favorite things I talk to people about is that if you're worried about the cost of going for it, you should see the price of staying exactly where you are. And I love this picture that we chose for this slide, because you can imagine the number of people that have hit that piggyback to take the money out. And we don't want to be like that. We've got to get some forward motion and get mortgage free quickly. So when we're talking about getting mortgage free, having a plan, you need somebody to walk by your side to help you. So we talk about coaching. A coach is somebody who tells you what you don't want to hear, who has you see what you don't want to see, so you can be who you always know you could be. And walking side by side with a financial advisor and a financial coach will actually help you get there. That's that accountability that we need. So at Enable Me, we've got lots of wonderful coaches. Here they all are. They're all here ready to help you when you want to. So that's what we're looking at. For this evening, thank you for coming along. If you do want to book a consultation with us, if you book tonight, the cost is $149 for the financial consultation. If you book after that date, it's a cost of $249. The normal price is $400, so it's a good savings already, reducing fritter. So now what we're going to do is we're going to have some questions and answers. So Amy, have we got some questions from our audience tonight?
We absolutely do. So thank you, first of all, Karen, for your time this evening, and everyone who joined us this evening. Here's some questions that were submitted when you registered. If you've got any more questions, feel free to use the question box that we've got open at the moment as well. So to start off with, Karen, my mortgage interest is coming up for renewal end of October. Do I float and wait until the next OCR announcement in November, or refix in October?
Okay, this is a really good question, and I will get my crystal ball. But what I would say, if I have a mortgage coming off in the end of October at the moment, I would be approaching my bank to see if I can get a discounted floating rate. So if you're not going to fix straight away, you're going to end up on a floating rate, you can go to your bank and ask for a discounted floating rate. So they might give you 0.5% off, or maybe a little bit more, depends. And then if you do have a discounted floating rate, remembering if it's the end of October, the OCR announcement is the 26th of November. So it's not too far away. You've just got to weigh up the cost of waiting. Now, we don't know what the rates are going to do at the end of November. We don't know that they'll come down. We think they will. But if it was me at the moment, I would probably float for a little bit and then look at fixing at the end of November. But the only problem you have then is that you have another OCR announcement in February. So you've got to kind of draw your line in the sand and say, well, when do I fix? So because the OCR announcements are quite close at the moment, so if it's the end of October and the OCR is the end of November. It's 1 month. I would probably just wait and fix when the OCR announcement's made at the end of November. That's that
Great.
one.
Thank you, Karen. Now, one just submitted now. Would you recommend getting mortgage-free before buying an investment property? So paying it off as fast as you can and then investing.
No, not necessarily. A lot of people think they have to be mortgage free before they can buy an investment property. You don't need to be. You just need to be comfortable with the mortgage that you've got and that you can still get mortgage free before retirement. So you don't want to take on a investment property, and you will probably need to top it up. So you've got to kind of think, well, if I'm going to top that investment property, which is an investment, that top up, am I going to be comfortable to do that and pay off my mortgage? And am I going to get mortgage free in time for retirement? You don't have to be mortgage free. And for most people, get to that stage that you're comfortable with your mortgage, you know that you can get mortgage free before retirement, get the investment property to try to grow that wealth. So using your leverage in that position.
Thank you. Now, also something that a few of us might be hoping for, if you recently came into a large sum of money, for example, an inheritance, is it better to pay off a lump sum or offset?
Okay, right. Well, hopefully the person that's left you the inheritance isn't anyone that's too close, because that would be pretty sad, but it is what happens. And I think as we're coming up, the generations coming through, there will be a lot more inheritance coming through. Apparently, I was reading just recently. Um, it is an important thing to really look after that money that the person's left to you, but you need to think about things like the Relationship Act, because as soon as you pay off your mortgage, if it's a joint mortgage and you've got, you're a couple and you're paying off a joint mortgage, that inheritance then becomes joint money. So you'd need to go and see a solicitor and have a separate sort of an agreement drawn up, a relationship property agreement drawn up, to say that if anything happened, that money is your money, it's part of your inheritance. So sometimes offsetting can be quite a good way of doing it, because you can keep that money in your own account yourself, and it just offsets the joint mortgage. But if you're offsetting, you receive no interest or no growth on that money. So you've just got to really weigh up what is better. I would definitely be getting some financial advice on that one through a solicitor and second through a financial advisor.
Thanks. Now, can you tell me, please, if my investments are likely to earn a higher return than my mortgage interest rate, should I focus on investing or prioritize paying off the mortgage faster?
I think paying off the mortgage faster, because it's a guaranteed amount. You know exactly what your mortgage is going to be. It's a fixed interest rate for a certain length of time. It's an amount that comes out of your pocket every fortnight or every month. I would be focusing on getting mortgage free first, and then looking at growing your wealth through other options later on. But I would always focus on mortgage free first. I think, it's a set cost, and it's a cost that will always be there. If you're investing somewhere else, generally, if you're looking at managed funds or shares and things like that, they are long term. So you wouldn't want to sort of invest in them. And then if you have to pay something off or you need that money, you just have to sort of sell those or close down your managed funds. So probably isn't quite the right structure at that point in time. Depends how much of a mortgage you got to go. But again, you'd probably need to get some financial advice, because that's quite a personalised thing.
Thank you, Karen. Now, another question that's just come through live. Is it okay to do a floating rate even though I'm on a fixed salary? No other sources of income other than employment.
So, a floating rate just means that you haven't fixed your mortgage. It really doesn't matter too much whether you're fixed or floating, whether you're employed or whatever. I would always have a mix of fixed and floating rate loans. Floating gives you that ability to be able to pay off lump sums when you want to, and the fixed rates kind of give you a bit more stability, knowing what your loan payments are going to be. If it's going to be floating, you might want to think of about a revolving credit facility, because as a facility you can draw back if you need to. So the structure of mortgages are really important, the way they get set up. But I would always have a mixture of fixed and floating. So whether it's fixed mortgages and a revolving credit facility, or a small floating rate loan to give you the ability to pay it off when you want to with no charges.
Wonderful. Okay, we've got one time for one more. Should we use our KiwiSaver money to pay off the mortgage on our rentals, or are we better off leaving it to grow as an investment if we are mortgage free and at retirement age?
Okay. All right. So you're at retirement age, you've got no mortgage on your own property, but you've got investment properties that have mortgages, and you've now got your KiwiSaver available to you. I would not be paying all of my KiwiSaver money off of an investment property. And the reason for that is you need liquidity when you're actually in retirement. Because unless you've got a lot of other money other than KiwiSaver, if you pay off the mortgage, when you go to get it back, the bank's not necessarily going to lend it to you because you've just paid it off and you don't have an income anymore. And you can't sell a bedroom in a rental property. So I probably wouldn't. I would be very, very careful about paying off any lump sum of an investment property. I think as you're getting towards retirement, you probably need to reassess how long you want to keep that investment property for because it is quite tied up. KiwiSaver is available for you to draw out even fortnightly, so you can top up your income from your super from your KiwiSaver. But if you pay that off of your mortgage on your rental property, it's going to be really hard to get that back if you need to. And as I say, if you've got a rental property, you can't sell a bedroom or the front stairs or the lounge when you need that money back again. And you may not be able to actually borrow it back. So probably the answer would be no. I would not be paying off my KiwiSaver money to pay off a mortgage on a rental property at retirement age.
Great. Thank you so much, Karen. And also, once again, for everyone who's joined this evening, if you've had any questions that we haven't been able to get to tonight about financial consultations or about anything that was raised today, just scan that QR code to visit our website. We've also got our contact details on there to reach out. We'll be sending out an email with a recording of this webinar tomorrow, but if you're waiting to or wanting to get that special offer on the financial consultation, please visit enable.me/your-future and book tonight. And I'll pass back to you, Karen, to wrap us up.
Yeah, lovely. Well, thank you guys for spending the time with me this evening. So hopefully I've been able to give you some words of wisdom. I would love to see you and speak to you. So I'm based in Christchurch, but our coaches are based throughout the whole of New Zealand. So we can either see you on Teams or we can see you in person, but we'd really love to be able to help you get mortgage free faster, but create a really lovely financial future for your retirement and your family. So have a lovely evening and thank you very much for your time. See you.